Yo, what is going on, guys? Welcome back to another video. Hopefully you guys are keeping well. Now today, guys, we're going to take a look at an extremely important topic, and understanding this topic can actually be the difference between you getting into high probability setups and low probability setups. Today we're going to be speaking about premium and discount, and as you know, guys, in these videos I simplify everything as much as possible. I guarantee that you're not going to find any simpler video on premium and discount on all of YouTube, so make sure you stick all the way through to the end. Now if you haven't already, guys, make sure to join my free Telegram mentorship. The link is down in the description. I share a lot of free tips on there, analysis, etc. Now I have absolutely no courses to sell you. I have absolutely nothing to sell you, so everything I tell you on this video is going to be everything that you need to know in regards to this topic. So without further ado, guys, let's get straight into the analysis. Okay, so let's get straight into it. Premium and discount. Premium and discounts are the best zones to trade from. Now let's take a look at what is premium and discount. Premium and discount essentially stands for the cheapest or the most expensive areas to buy or sell from. So premium is selling something at an expensive price, and discount is selling discount is buying at a cheap price. So let's take this for an example. Think of it this way, guys, right? At different levels, there's going to be different areas of demand. So when a shoe is $100, it has a certain level of demand for it. As the price drops, the demand increases. So when there's a shoe, right, and it's $100 and it drops at a discount, it drops to a discount, it's discounted to $70, there's obviously going to be more demand for that product. The same thing, if you own something, what you want to do is you want to sell it at a premium. You want to sell it for more than you bought it. So you want to sell it at expensive prices. This is how you profit. So this is the idea between premium and discount. What we want to do is we want to essentially buy low. So this is where the idea of buying low and selling high comes from. What you want to do is you want to buy low at a discount, and you want to sell a high at a premium. So this is the price chart, right? And we understand that a price chart, all these candles tell us, essentially it gives us two things. It gives us the open and the close for a certain time frame, and it gives you where price has traveled in time. Okay, that's all that's essentially all it's going to tell you. So when we take a look at the price chart on TradingView, you're going to see all the different prices right here to the right, and essentially the lower you are on the chart, the cheaper price is, and the higher you are, the more expensive price is. So anything down here is all going to be discount. These are cheap prices. Anything above here, this is going to be premium. These are expensive prices. Now, why do we need premium and discount measurement? Why do we actually need to measure premium and discount? Well, first of all, you get higher probability setups. Okay. Second of all, you get larger momentum backed by larger demand by participants. What does this mean? So, as I said, if there's going to be more interest in the shoe at $70, there's more people that are going to be interested in buying it. Okay, so when you have more interest in something, you're going to have a lot more volume. So buying something at here, for example, and buying something here, there's going to be a lot more participants lower. There's going to be a lot more participants in the discount. This is good because a lot of time when you're buying right at the discount, the cheapest prices possible, a lot more interest, a lot more buyer interest is going to be in the market. And this is good because this means that you're going to have a lot more momentum pushing you while you're within the trade. And once again, this also helps us with avoiding weak moves. If we're not buying right at the discount, you can be sure that not a lot of people are interested in buying at that certain level because a lot of people are waiting for lower prices. Okay, and there's a very, as I said, there's a very strong correlation between supply and demand and premium and discount. So how do we measure it? By measuring price swings throughout market structure. So as I said, this is simply historical data, and it's giving you data in regards to price. So what we do is we use the Fibonacci tool, and a lot of people think the Fibonacci tool is a magic tool and it has magic numbers, etc. It's not. We simply use it to calculate where the premium and discounts are. So what we're going to do is we're going to hop onto the chart right now, and I'm going to show you how we use it to calculate it in the candlestick based chart. So here we are on TradingView, and to pull up your Fibonacci tool, you have to head here, pick the fib retracement. And what you want to do, guys, right, to change the settings is to click on it right here, click this icon and just copy my levels right here. And essentially these are different levels, and these are essentially the best levels that I've noticed over my years of experience that have given me the best levels of premium and discount. So copy it all right here, and you can also use my settings for the opacity right here just to give it the same look as me. So it's very, very simple, and I'm going to break it down to you right here. So what we do is we take a look at market structure, and in order to mark out the Fibonacci tool, we want to take a look at it from a low to a high or a high to a low, depending on if the market structure is bullish or bearish. So if the market structure is bullish, we have something that looks like this. What we want to do is we want to drag the Fibonacci tool from the low to the high. So we look at the origin of the move. So from the swing low to the swing high. And right here, guys, the levels are marked out by the 71, 78.6 and 88.6. Now, when we take a look at bullish structure, we're looking for buys. That means we're looking for discounted areas, because we buy from a discount, we sell from expensive prices, from a premium. So what we do right here is when we drag it from the low to the high, essentially we're taking a look at this price swing, and we're determining that anything below the 50% is always the equilibrium. It's the middle. It's neither expensive, neither cheap. It's right in between. So we take a look at this price swing, and we determine that the cheap pricing, the discount, is here. These levels, 71, 78.6 and 88.6. So essentially what we want to do is we want to wait for price to drop down into these levels right here before looking for a buy. And once a new high forms right here, so as you can see, we have a new high that forms right here. We drag the Fibonacci tool once again to our new low, from our new low to our new high, and the levels change right here. So let's say this swing literally just comes down to 50%. Well, sometimes it does do that. But does that mean we're interested in buying from here? No, we're only interested in buying when price drops into the 71, 78.6, 88.6. The lower the better, because as I said, the cheaper it is, the more demand. The cheaper it is, the more people will be interested in looking to buy from your desired area. Once again, you have a new high that's formed and it breaks the previous high. We look to take a look at it from this low to this high. You simply keep moving it like that. Now, let's go take a look at it from an actual chart perspective. So let's take a look at it right here. What do we have right here? I'm on your GBP on the 4-hour time frame. Doesn't matter what time frame you apply it on. The idea of premium and discount still applies the same. So we take a look right here, and we can see that we've broken structure right here. So essentially, I'm looking for buys now. So that means that this is my lowest low, this is my swing low, and this is my swing high. So I drag it from the low to the high. Now, as price, okay, I'm going to use the replay tool to keep it simple. As price retraces back down, what I'm looking for is for price to tap into 71, 78.6 or 88.6, and then I'm looking for buys. So as price plays out, it taps the 0.5. I'm not interested in looking for buys from the 0.5. So this means that any point of interest within the 0.5, I'm not looking to enter from. So if we're trading from supply and demand, or we're trading from order blocks, institutional candles, whatever you want to trade from, if it's in the 0.5 level or above, I'm not interested in looking for buys from. I'm only interested in looking at order blocks somewhere within here. So as you can see, as price taps in, it gives it a rejection, but we want to take a look at lower. And then boom, price taps into 71, and now it starts rejection. This is a fairly decent level to look for buys from, because this is cheap pricing. And as you can see, price rejects from here nicely, and it keeps going, and eventually price forms a swing high right here. So now what we can do is we can take a look at the low that formed that high. So we take a look at the low that formed this high right here. And once again, where our discounted areas right here, 71 to the 88.6. So what I'm waiting for is for price to retrace back down into here, and then I would look for buy setups. Now, does that necessarily mean that price has to come back to these levels? No. Sometimes price will decide to only come back to the 50 and go. But when we approach trading, guys, right, we approach it from a very mechanical based perspective. So it's a simple if. It's an if scenario. If price retraces here, I will execute. If price does not retrace into here, then I'm simply not going to execute. It's as simple as that. Keep it very, very simple. Keep it very, very, very systematic. Anyways, so we're waiting. So once again, what happens here is we end up switching our pullback style. So this is something that I'm going to teach you when we take a look at market structure. So price will sometimes, depending on the momentum and the strength of a currency, the pullbacks become a lot less deep. So when we take a look at it, right, and we're going to drop into the two-hour time frame here, keep things simple. Let's take a look at it right here. So once price starts creating very, very volatile moves to the upside, and one currency is a lot stronger than the other, you get minor pullbacks. Okay, so there's something called major and minor pullbacks. Subscribe to the video right now, guys, and give this video a like, because I'm going to speak about this very, very soon on the channel. So we take a look at this low that's broken a previous high. So we drag it from low to high. Okay, and I'm going to use the replay tool once again to simplify this. So from low to high, and we wait for price to drop to the 71, and any point of interest within this area, within the discount, I'm looking to buy from. So right here, this looks like a good zone to buy from. So this is my order block right here. Price taps in, 71, away it goes. So now we formed a new high right here, and I need to see some, okay, there we go, the confirmation. We got a bearish engulfing candle. So this is my new high. So what I do now is I drag this from the low to the new high, and I look for my point of interest that lies within the discount. So you can see this open of this institutional candle or order block lies within the 71 discount level. And I'm dragging once again, and this is where I look for buys from. So once again, price comes back down. It fails, okay? It just about misses the 71, and it fails to tap into my discount. That's fine, no trade, but the concept still remains the same. So once again, we have a new high formed, and the low that formed the high, this is where we take a look and we adjust our Fibonacci tool. So once again, I'm looking for price to tap in to my discounted area, and if it does not do so, I simply don't look for a trade. Now price comes down. Once again, fails to break any higher right here. So what I'm doing is I'm waiting, and price has tapped into my discount, the 88.6. Okay, so what you would have done right here, as you got a new high form, as you would have seen a new high form, you would adjust it. You'd continually adjust it. So once again, you adjust it. Just like so. The price taps in, comes down into the 88.6. We have our point of interest right here. And once again, this would have been a new area for you to look for buys from. Now let's take a look at an example of a few sell setups. So right here, we are on GBP JPY. And essentially what you see is we had a change of character here, our market structure shift. So the market is now looking for sell setups. So what do? We look at the high and we look at the low. So right here, I will only look for sells if we reach the premium levels. So when you're looking for sell setups, you're dragging from the high to the low. And that means the 71, 78.6 and 88.6, this is where we look for sells from. So as price retraces back up, we're only looking to short from here. Now, if a new low forms under this low, then obviously we would adjust as the market moves. So we'd still wait. And once we reach these levels, this is where we start looking for sell setups. So this is a nice order block right here on the 1 hour that lies perfectly on the 78.6. This is where I'd look for my short. So boom, we short here. Once we get a new low form, okay, so once we get a new low form, I will look to adjust my order block. Now, once again, it depends on the time frame that you're trading, because what a lot of people will do is they will also trade this inner structure. So if you're trading this inner structure, you could have essentially had it from this high to this low. And once again, you would have been trading this order block that lies with 88.6. And once again, that's another beautiful trade. But if you want to keep it very, very simple in your swing trading, stick to the higher time frame swing lows and swing highs. So once again, you'd wait, still, okay, now we got a structural break. So what we do is we look at the high that formed. Okay, we want to find the high that formed that low right here. And essentially, this will be the high right here. So as we move, this is the swing high that formed our swing low right here. and we wait for price to tap in higher. Does that necessarily mean that price will always go to your premium level? Not necessarily, but I'm only executing if we go into that level. As price continues to move. Now we formed another low. It failed to come up here. We formed another low. So now I'm adjusting the high that formed our low. Now let's just see if this is set. Okay, perfect. Now we wait here. And now we wait for price to trace into one of these levels. The order blocks within here are good zones to look for sell sells from. So somewhere within here. You're waiting and you're waiting and you're waiting for price to do its thing. You're still waiting, and boom. Eventually, price taps into my 88.6 right here. Perfect order block. If you take a look at it from the higher time frame, right here on the 4 hour time frame, this is a perfect order block to short from. And once again, that's a beautiful trade that you could have taken. It's all about being patient and waiting for price to tap into your premium or discount, because the importance is here is that the volatile moves and most interest, the most market participants will be sitting with their pending orders, with their passive orders right at these levels. And with that being said, guys, this concludes the lesson on premium and discount. If you found this video useful, make sure to drop a like on the video. And once again, make sure that you join my free Telegram mentorship. The link is in the bio. I'll be posting a lot of tips, my chart analysis, etc. Everything is for free, guys. Remember, once again, I don't sell any courses, etc. I only have one coaching program, and that's currently closed. So if you want to keep up with that, if it ever does open back up, it only runs 2 to 3 times a year. As I simply like to focus on working with people on a one-to-one basis. I don't believe that courses are actually that useful. So yeah, if you want to keep up with me, guys, make sure to also follow me on Instagram at MomoFUFX. With that being said, hopefully you enjoyed this lesson, and I will catch you on the next lesson. Have a great day.